Hey guys, welcome back to the channel. It's Pete. This is where we talk about money, finances, where we give you information and education to help you make the best financial and investments decisions possible. If you are new to the channel, welcome. If you are a returning subscriber, I love you. Thank you very, very much for being here. Today's video is going to be a continuation of Hargreaves Lansdown and the reviews that we started with them about 2 weeks ago. In this video, I'm going to talk you through how to select funds with them. I'm going to be looking through their fund shortlist. I'm going to be explaining what you're seeing if you're looking to use them. So a lot of the times what happens is you go onto these websites, you look at the information, and then there's like this acronym or something, and you get confused. You don't really know what it means. You're not really too sure what to pay attention to because these things have a lot of information just there, and you then have to decipher what that means. So I'm going to be talking you through that this video. And look, if you are new to the channel, you've only just found me and you want to learn how investments work, you want it to be explained in simple plain English, that's what I try to do here. At least that is what I do here. So make sure you subscribe, hit that like button. The like button's really, really important, guys. If you don't like the video, YouTube will just assume that this is absolute rubbish and it won't show it to other people. And it's really important. If you're on this journey trying to learn about investments, help this video get out to help people just like you. And definitely hit that notification bell as well before you leave. I upload every Tuesday and Friday at 5 p.m. And the notification will just allow you to be aware of when I upload videos. So with that being said, you know what time it is. Let's go. So just a little bit of housekeeping, guys. So if you've not watched the first 2 videos in this series, I definitely suggest that you go and watch them. They are in the playlist linked to this video right here. In the first one, we had a look at Hargreaves Lansdown for monthly investors. That may be you. So if you wanted to invest something like £30, £50 a month, then that video will help you. I also did a video where we looked at their ISAs. So again, if you're investing on a monthly basis, the best thing for you to do would be to start with your ISAs because they are tax-free, and that's the first rule of financial planning. Think tax efficiently. You're probably going to watch that one as well. But for this video, we're going to be talking about their fund shortlist. So let's just cover a little bit of the basics around what a fund is. The way I always explain funds is that it's like buying a box of Coronation Street, right? So in the tub, you've got lots of different chocolates in different wrappers. And essentially, that's what a fund is. You're investing your money and buying a box of Coronation Street. So the chocolates that are inside the box of Coronation Street are essentially your company. So there will be the FTSE 100, for example, there will be the FTSE 250, there could be the S&P 500. But it means that when you invest in a fund, you're buying a box of Coronation Street and your money is invested in each of the companies that sit inside this box of Coronation Streets. And the idea is that with a fund, number one, you can access the markets at a low cost, but you also get diversification. So in other words, if you want to generate wealth and you understand that invested in the stock market, investing in companies is a key component to actually making that happen, then essentially what you're doing is you're buying as many companies as possible. You're not just relying on a handful of companies to generate the wealth for you. And the reason why that's important is because if you bought 100 companies and let's just say 20 of them didn't do well, you still have another 80 that could. That's very, very different than if you held 12 companies individually via Trading 212, for example. It means that you're going to be reliant on all 12 companies or a good proportion of those 12 companies to perform well in order for your portfolio to grow, for you to generate wealth. This is all about diversification and managing your risk as an investor. So funds give you the ability to invest in the market at a very, very low cost. It diversifies your risk, meaning you're not taking too much risk because you're buying 100 companies as opposed to just a handful, maybe 12, 15 or so. So it gives you a better chance of success. And remember, when you are investing, the most important thing is that you do it in a way that allows you to stack the odds in your favor. When you invest, you're never gambling. This is calculated risks, calculated decisions that you are making. So it's all about stacking the odds in your favor to the best of your ability. Now let's jump onto Hargreaves Lansdown. Let's have a look at their fund shortlist. And I'm going to talk you through some of the information that you are going to come across and just explain to you what some of that information essentially means, at least the stuff that you really should be paying attention to. So this is the Hargreaves Lansdown website. Familiar by now, but there we go. We're just going to go on to funds here. Now, I do want to point out one really important section here on funds, and that is the get started piece here. So this is some educational stuff that, again, if you just want to kind of like top up your knowledge, just to make sure that you are really sure of what you're actually doing and what you're actually buying, then it is worthwhile reading this. You go how to invest in funds, a guide to investing in funds. You've also got funds frequently asked questions as well. So if you've got a little bit of time, spend some time reading through this in conjunction with this video. Again, whenever I do these videos, yes, I'm coming at it from the point of view that I am a financial advisor. Well, I'm a qualified financial advisor. I'm not advising currently, but I always try and make sure that when I do this, I look at it from your point of view. Do you understand this information? Would you be able to understand it without having to second guess yourself and possibly picking the wrong option for you? So this is all about empowering yourself. So use this in conjunction with the information that they provide you to really consolidate your knowledge, consolidate your understanding of what you're actually going into. So those are 3 areas that definitely worthwhile paying attention to. What we want to do is we want to go onto their fund shortlist, which is this one right here. So here you've got a little bit of information around categories. So you've got some funds for income, you've got funds if you're seeking retirement income, and you've got established trackers as well. Now, if you are the kind of person that you are investing at this point in time and you want an income to kind of supplement your current lifestyle, then these funds may be the ones for you specifically. I mean, what it basically says is we filter down the full ranges of funds to those in the wealth shortlist and with a historic yield of 4%. If you watch my video from Tuesday, I referenced the 4% number. The 4% number is essentially the safe level of withdrawal that we feel, or the industry feels, is adequate for you to take if you're looking for an income without really diminishing and destroying the initial investment that you have. So for example, if you have £100,000, the idea is if you're looking to generate an income, you want to be able to take out enough income knowing that your £100,000 capital essentially stays intact. We think, or the industry thinks, that 4% is the right amount for you to withdraw in order for you to preserve your capital. They kind of allude to this here as well. If you're seeking retirement income, it's exactly the same. They're looking at about the same yield. What I want to do for the purpose of this video, though, is actually have a look at their established trackers. So I want to view the funds here. Now, a tracker fund is essentially a fund where, for example, they might buy the FTSE 100 or track the FTSE 100. Now, the FTSE 100 is a list of the UK's top 100 companies. So there are banks in there, there are building property developers in there, there's pharmaceuticals in there, there's all kinds of companies in there. And a tracker will essentially say, well, all of these companies are included in the FTSE 100. We will track the performance of the FTSE 100. So in other words, if the FTSE 100 goes up by 5% today, you should see that same performance mirrored in your tracker fund. Equally, if the performance of the FTSE 100 should go down, say 3% on a particular day, you should also see that reflected in your tracker fund. But again, the whole point of a fund is that it allows you the ability to buy 100 companies. So that box of Coronation Streets all in one go. And it allows you to know that you've got your money invested across 100 companies in opposed to 20 or 30. So the more companies you have, the more you're able to manage your risk. So you're more diversified. And it means that you're reliant on a greater number of companies to come through in order to generate the wealth and the profits that you want in order for you to be profitable as an investor. So let's have a look at their fund list for this here. Now, lots of information here. They talk about what filters they use and why. So they have a look at sectors, indices, sorry. So indices are essentially markets. So I've referenced the FTSE 100. That is effectively an index or an indices, right? So they're looking at Asia Pacific, excluding Japan. They're looking at Europe, excluding the UK. They're looking globally, which will be more of a holistic view from a global point of view. Japan, North America is essentially the States, so the S&P 500, that kind of stuff. Then you've got the UK. So those are the sectors or the indices that they're essentially looking at from a geographical point of view. They're looking at fund sizes. So they're looking at fund sizes of a minimum of £1 billion. The reason why that is important is when we get into costs, the bigger the fund, the more negotiating power they essentially have. Let's put it this way: if someone says to you, "Well, we want to employ your services, but we're going to give you £1 billion," there is more room for them to negotiate your costs down to manage this fund, or purchasing power, as you might put it. So they're looking at £1 billion minimum. It's saying on here that they've got ongoing charges figure less than 0.5%. We'll talk a bit about that a bit later on. And they're saying that this fund type is essentially a tracker. Now, it does explain here there are two types of funds: actively managed, where a fund manager aims to perform better than their benchmark over the long term, and index trackers. So this is a tracker also known as a passive fund, which aims to track their index as closely as possible. So it's kind of what I explained before. With an actively managed fund, you've got someone who's making the decision. So what they'll say is, well, we think that the FTSE 100 historically, and they can tell this, has done 7%. We're going to try and beat that and try and get maybe 8 or 9%. That's actually having people, a team, sat behind the decision makers. So picking what companies they're going to invest in, determining whether they hold a company or sell a company at any given time. Whereas with a tracker, it's more passive. So it's simply tracking the performance of the FTSE 100, for example, which is an index. So again, if it goes up, you'll see it reflected in your fund, in your tracker fund. If it goes down, you will also see that reflected in your tracker fund as well. So let's go on to the list and see what they have available here. So there is a long list here. So what I'm going to point out is Hargreaves Lansdown do have a wealth list, which is kind of like a short list of some of the top performing funds that they think are worthwhile purchasing, and some of their most popular ones as well. Those ones are denoted by this green star right here. Now, as you can see, there's quite a few here. There's actually 3 pages worth, and it all gives you a little bit of information around, where are they sectors. So this is an all UK companies here. That's an American stock market. That's more global, so it has more of a holistic view. This is it, Europe excluding the UK. Then you've got more or UK global. You've got some Japan ones in there. Now, what you'll also find here is that you do have charges. So, for example, for this one, the ASI UK All Share Tracker, this one is a medium in terms of how much it actually costs to buy in or own this fund. The others you'll see are pretty low. So you can add these to your watch list. So if you're going to be doing your research and you kind of have an idea of where you want to begin, or even if you don't have an idea of where you're going to begin, it might be worthwhile just checking out a few of these and adding these to your watch list, because what you probably want to do is probably do a little bit of comparison just to make sure that you're making the right decision based on what your investment goals are. I'm not going to talk about investment goals because I talk about this a lot all the time, but it's really important that you need to have a clear idea of why you're investing and how picking a fund, any one of these, is going to get you closer towards your goal. Your goal is your overarching principle. It will inform your plan, so it will inform which funds you buy, why you buy them, and how long you decide to hold these funds for. So very, very important. I want to go through one of them with you. So let's go through the Fidelity Index World Class P. So let's have a look at this. And by the way, guys, really important piece of information. So where you're seeing, obviously on the side here, all of these are trackers, as we've already established, but some of them you'll see the denotion of income. What that essentially means is that it's going to be paying an income. So again, if you're looking to invest because you want to supplement your income, you want to choose a fund that has the designation of income. Accumulation simply means that it's there to accumulate effectively for growth. So it's not paying an income, its target is to grow. So it's accumulating all of the growth, all of the returns for future use. A really, really basic differentiation that you need to understand if you are going to be using these guys and you're trying to pick a fund. So again, what is your investment goal? Are you looking for income or are you looking for growth? That really dictates what fund you're going to buy. If you're looking for income, you're not going to go and buy an accumulation fund because it's not designed to do what you need it to. Equally, if you're looking for growth, you're not going to go and buy an income fund because, again, it's not going to do what you need it to do based on your goals. So let's have a look at this Fidelity Index World and see what it has to offer. And I'm going to talk you through some of the information that you'll find in there. So it's got all the key information here in terms of the buys and sells. That's completely fine. What I want to do with this one, though, is actually just pay attention to some of the main bits of information that this is presenting you. So there are no dealing charges, zero. There's no initial charge. There's no savings. They're not passing on any savings to you. There's no initial charge at all. So this column, it means that for you to get in, doesn't cost you anything upfront at all. Now you've got annual charges here. So there is no performance fee, but you do have an ongoing charge or a total expense ratio. So TER means total expense ratio. Now that's pretty good, and that's really what you need to be looking at. Your total expense ratio is essentially the cost of managing and operating a fund just like this. This will take into consideration all costs, legals, admin, everything. So what you need to be paying attention to is your total expense ratio, or your TER, when it comes to the cost, low. For this one, it's 0.12%, which is very, very, very good indeed. You've got some other bits and pieces in here as well that are worthwhile reading. And you've also got other information around who the actual manager is, when it was actually launched. It's a global fund. There's 1.8 billion in there. It's got 1,610 holdings. It is a OIC. So this word right here, we pronounce it OIC. It means open-ended investment company. What that essentially means is that you don't have to hold this for any period of time. So you can enter and you can exit at any given time. It isn't fixed, or you're not contracted to hold it for a minimum period or a maximum period. It's simply open-ended. These kind of like acronyms can be very, very confusing, but essentially that's what it means. An open-ended investment company means you can get in, you can get out, you don't have any fixed term. It is an accumulation fund. Dealing frequency is daily. Validation point is at 12 noon. Your minimum investment, £100. Your minimum regular savings value, £25. So this is really important information that you need to pay attention to. But I do want to talk about charts and performance and going through some of the other stuff that really, if you're buying a fund, you need to know what this is all about. So this is a simple like performance chart. You can see back from 2015 how this has performed. Now, clearly, past performance is no indication to future performance. But the way I always say this to people is that, if you are going to compare this fund with another fund, then you do want to have a look at how it's performed when you get to instances like this, where the market has dropped off. Has it kept pace? Has it fallen, sharper than the fund that you're in? There will be reasons behind all of that. It could be with the way the fund is set up or how the fund is managed, but you should be paying attention to that. If it's a tracker, there's not really much you can do because it's simply going to mirror what's happening with whatever it's tracking. But if it is an actively managed fund, then you would expect that it would not dip anywhere near as close as this one did with an actively managed fund. You would expect that it only comes down to around about here on the graph, because there is a person actually making decisions whilst all this is happening. You would hope that they would have made a call to get out and put your money into some safe haven so you didn't see that drastic of a drop, according to here that's in the graph. So you can see here November the 11th, 2015 to 2016, that's the return. Pretty decent, really, really decent. You've got the cumulative performance as well, looking at 3 months, 6 months, 1 year, 3 year, and 5 years. I do want to pay a little bit of attention to the fund analysis though, because this is some key information that you need to know. And the fund analysis will essentially walk you through what this fund, how it's built, what's in it. And this information is so important. On my course, I talk about asset classes and asset allocation. And this is going to talk to you about what the asset allocation is. So for example, here, what it's essentially telling you is you've got majority of your money in international equities. So international businesses, international companies. You've got about just under 4% in UK. You've got a little bit in other, a little bit in cash and equivalent, right? A little bit in property, will be commercial property, not residential property. You've got some alternative trading strategies in there, international bonds. You've got some money markets and some managed funds in there as well, but very, very small. This is worthwhile actually paying attention to, because this will be important when it comes to understanding what level of risk you're taking with your investment. And again, the risk side of things is a key question that you need to be able to answer. Then you've got the top 10 holdings. So companies that you know, Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, Johnson & Johnson, Nestle, Procter & Gamble. These are all big international companies. Most fund managers or people who provide investments like this will only show you their top 10. A lot of them won't give you the full list because that is pretty much intellectual property, but your top 10 will be companies that you already know. Then it talks about what sectors they're invested in. So you've got technology, telecoms, financials, real estate, consumer discretionary, consumer staples, energy, utility, healthcare industries. So this tells you that they're investing your money across a good geographic spread, but also across a number of different sectors as well. And again, this adds to your diversification, i.e., managing your investment risk. So this is really, really important, and some of the stuff that you need to pay attention to if you are going to be using Hargreaves Lansdown to buy funds specifically. You can build your own investments within this, but if you are the kind of person who doesn't really have the time to do that kind of research and you want something that's already built, what I've just shown you right here is going to give you a really quick in and out, set it up, pick it, and open your account, and your money just gets invested in other companies that we've just highlighted there and across the sectors that we just highlighted there as well. It's a really good hands-off approach, knowing that some professionals have actually done some work to build this fund for you, and it's going to be managed by those same professionals as well. You can get, again, very, very hands-on with this kind of stuff, but if you are the kind of person that you just want to make a selection, send money across, this is going to be perfect for you. Let me know what you thought in the comments. I'm sure there will be questions, so ping them down there. Yeah, and if you are using Hargreaves Lansdown, let me know how you feel about using their funds. I've got some of my investments with them, but I've got them on the direct shares piece because I do buy direct stocks as well. Not that many. I normally invest in funds because, again, diversification is really, really key for me. And I like to make sure that I'm invested across a number of companies as opposed to relying on maybe 20 or 30. These guys are doing a lot of work in selecting these companies, so why not use their expertise? But if you are the kind of person who wants to buy individual stocks, there is a link in my bio. You can get some free shares of either Nike, GoPro, or Dropbox with stake. Simply use the link in my bio. Remember, you've got to fund your account within 24 hours of opening your account. Otherwise, you do not get your free share. Don't forget that. I've had a couple of people message me and it's like, you've got to fund it within the first 24 hours. But I think it's about up to 100 quid. There's a link down there. Grab yourself a free share. But guys, thank you so much for listening. If you're not listening to the podcast, there you go. Catch you next week. Have a great weekend.